What if I told you that right now, as you're watching this, a bank holding billions of dollars in deposits could already be under quiet federal control, and its customers have no idea? No breaking news banner, no locked doors, no panic in the streets, just signatures on confidential documents, closed-door meetings, and regulators stepping in silently. Because in modern banking, failure doesn't always look like collapse. Sometimes it looks like business as usual. Your debit card still works, your app still loads, your balance still shows on the screen. But behind the scenes, control may have already shifted. This isn't a conspiracy theory. It's a legal mechanism buried deep inside U.S. banking law, one that allows regulators to take operational control of a struggling institution without triggering public panic. And if you have deposits above the insured limit, what happens next could affect you directly. Stay with me, because by the end of this video, you may never look at your bank account the same way again. 3 banks, quietly restrained, still open, still taking deposits, still telling customers everything is fine. But behind conference room doors and encrypted regulatory calls, something very different may be happening. My name is Andrew John, and for the next few minutes, I need your full attention. Because what you're about to hear isn't rumor. It isn't social media panic. And it isn't another dramatic headline that disappears in 24 hours. It's about a mechanism most depositors never think about, a legal authority embedded inside the framework of the Federal Deposit Insurance Corporation. This power was granted under the Federal Deposit Insurance Act and expanded in 1991 through the FDIC Improvement Act. That authority allows regulators to step inside a struggling bank quietly. No press conference, no public seizure, no dramatic headlines, just control from the inside. Most people imagine bank failure as a dramatic scene. Doors locked, news vans outside, executives escorted out. That does happen. But there's another version. Slower, calmer, more controlled. The bank stays open. The logo remains on the building. Debit cards still swipe. Online banking still works. Yet the decisions are no longer fully theirs. This is what I call operational containment, a quiet phase between stability and collapse. And right now in 2026, the frequency of these quiet interventions is rising, particularly among regional banks with heavy exposure to commercial real estate. These aren't tiny community lenders. These are institutions with tens of billions in assets. Banks that handle payroll for cities, operating accounts for mid-sized businesses, and deposits for families who believe they are parked safely inside insured walls. So why would regulators choose silence? Because panic spreads faster than insolvency. A public seizure can trigger fear across healthy banks. Depositors rush, liquidity evaporates, confidence collapses, and banking, more than any other industry, runs on confidence. Imagine a crowded theater. If one person shouts, "Fire!" chaos erupts, even if there's no flame. Regulators learned long ago that sometimes the most powerful move is not a dramatic rescue, but a quiet containment. There's a continuum in bank supervision. On one end, normal operations. On the other, full receivership where shareholders are wiped out and assets are sold. In between sits a gray zone, consent orders, supervisory agreements, confidential restrictions, capital requirements imposed behind closed doors, senior executives replaced, dividends suspended, balance sheets micromanaged. To the public, nothing seems wrong, but internally, every decision requires regulator approval. History shows us this pattern. During the savings and loan collapse of the late 20th century, hundreds of institutions were allowed to continue operating under regulatory forbearance. Losses were mounting, but closures were staggered to prevent system shock. Investors who recognized the signals early protected themselves. Others trusted appearances and paid dearly. Fast forward to the 2008 financial crisis. The headlines only showed the banks that officially failed. What you didn't see were dozens more operating under intense supervisory control, restricted, monitored, quietly unwound. Markets always knew before the public did. Subordinated bonds trading at deep discounts, executives resigning suddenly, dividend cuts framed as strategic repositioning. It's never the announcement that tells the story, it's the pattern. And today those patterns are forming again. Commercial real estate loans made during the era of ultra-low interest rates are now colliding with a world of higher rates and lower occupancy. Office towers financed at 3% interest are now refinancing at 7%. Buildings are half empty. Property values are falling. The numbers no longer work. When loans mature and borrowers can't refinance, the losses shift to the banks. Quietly at first, then all at once. The next part might completely change how you see your own bank, because we're about to examine the warning signs that regulators don't advertise, but markets always detect. Stress in a bank rarely announces itself with sirens. It leaks out in subtle ways. A dividend is reduced. A chief financial officer resigns to pursue other opportunities. A footnote appears in a quarterly filing about heightened supervisory engagement. To the average depositor, these are background noises. To seasoned analysts, they are smoke signals. Let's break down the anatomy of distress. First comes capital preservation. dividends shrink or disappear, share buybacks pause, management speaks cautiously about strengthening the balance sheet. Banks don't stop rewarding shareholders unless they have to. Capital is oxygen. When it's conserved aggressively, someone is worried. Next comes executive turnover. Risk officers depart, finance chiefs rotate out. Sometimes regulators insist on leadership changes as a condition for continued operation. It's like replacing the captain mid-voyage while assuring passengers the sea is calm. Then, liquidity patterns shift. Banks begin borrowing heavily from backstop facilities. The Federal Home Loan Bank system becomes a lifeline. The Federal Reserve discount window usage increases. These tools exist for stability, but sustained reliance signals that deposits alone aren't enough. Markets notice before customers do. When a bank's preferred shares or subordinated debt begin trading far below face value, institutional investors are pricing in risk. Bond markets are ruthless. They don't respond to reassuring press releases. They respond to probability. Consider what happened before the collapse of Washington Mutual in 2008. Months before its official seizure, its stock price cratered and credit markets screamed distress. Insiders saw the writing on the wall. Retail investors saw comforting statements. The difference between those two perspectives was timing. Today, regional banks with high commercial real estate exposure are showing similar fingerprints. Take New York Community Bancorp, a sizable institution, major presence in multifamily lending. When it sharply cut its dividend and reported unexpected losses tied to real estate exposure, markets reacted violently. Capital was raised under terms highly dilutive to shareholders. Supervisory agreements followed, officially open, operationally constrained, or Valley National Bancorp. Significant exposure to urban multifamily properties, rising loan loss provisions, share buybacks halted, earnings calls heavy with defensive language. And then there's Flagstar Bank, absorbed into a larger entity in what was presented as strategic growth, yet the combined balance sheet amplified real estate risk at a fragile moment. None of these institutions have been publicly seized. But the signals align with enhanced supervisory oversight. And here's the psychological layer most people miss: normalcy bias. We assume tomorrow will resemble yesterday. If our debit card works, the bank must be fine. If the branch is open, stability must exist. Banks understand this. Regulators rely on it. Because confidence buys time. Yet time doesn't erase mismatched math. Commercial real estate values in many metropolitan areas have fallen 20 to 40% from peak levels. Loans made during euphoric years are maturing now. When borrowers cannot refinance, losses crystallize. Accounting rules allow banks to delay recognition temporarily, but maturity dates cannot be postponed forever. Picture a dam with hairline cracks. Water pressure builds slowly. From a distance, it looks solid, but internally, strain accumulates. Most people never hear the next part, and that's the real danger. Because next, we confront the question no depositor wants to ask. What happens to your money if containment fails, and how do you protect yourself before headlines break? Thanks for watching, and be sure to follow for the next part. Or Valley National Bancorp. Significant exposure to urban multifamily properties. Rising loan loss provisions. Share buybacks halted. Earnings calls heavy with defensive language. And then there's Flagstar Bank, absorbed into a larger entity in what was presented as strategic growth. Yet the combined balance sheet amplified real estate risk at a fragile moment. None of these institutions have been publicly seized, but the signals align with enhanced supervisory oversight. And here's the psychological layer most people miss: normalcy bias. We assume tomorrow will resemble yesterday. If our debit card works, the bank must be fine. If the branch is open, stability must exist. Banks understand this. Regulators rely on it. Because confidence buys time. Yet time doesn't erase mismatched math. Commercial real estate values in many metropolitan areas have fallen 20 to 40% from peak levels. Loans made during euphoric years are maturing now. When borrowers cannot refinance, losses crystallize. Accounting rules allow banks to delay recognition temporarily, but maturity dates cannot be postponed forever. Picture a dam with hairline cracks. Water pressure builds slowly. From a distance, it looks solid, but internally, strain accumulates. Most people never hear the next part, and that's the real danger. Because in part 3, we confront the question no depositor wants to ask. What happens to your money if containment fails? And how do you protect yourself before headlines break? Let's bring this down to something personal. Imagine you run a small manufacturing business. Payroll hits every Friday. Vendors expect payment. You keep $800,000 in a single regional bank because it's convenient. It's local, it's familiar. Technically, only $250,000 is insured under FDIC rules per ownership category. The rest, uninsured. That doesn't mean guaranteed loss, but it does mean exposure. If regulators transition from quiet supervision to formal receivership, access to funds above insured limits can freeze while resolution unfolds. Even insured balances may take a short period to become accessible. For a household, that's stressful. For a business, it can be catastrophic. In extreme scenarios, uninsured deposits can be converted into equity under modern resolution frameworks. That means your cash becomes shares in a struggling institution. It sounds dramatic, but similar mechanisms have been used internationally. So what do? First, audit your exposure. Know exactly how much you hold at each bank. Diversification isn't paranoia, it's risk management. Second, understand alternatives. Short-term U.S. Treasury bills and Treasury-focused money market funds carry direct government backing. They don't depend on a bank's commercial real estate portfolio performing well. Third, monitor signals. Read earnings reports. Pay attention to supervisory disclosures. Watch capital ratios and loan concentrations, not obsessively, intelligently. We are late in a credit cycle that began after 2009, when near zero interest rates encouraged aggressive lending. The assumption was simple: rates would remain low, property values would rise, growth would continue. Those assumptions shifted. Interest rates climbed rapidly, property demand changed, remote work reshaped office markets, retail corridors emptied. Banks that concentrated heavily in those sectors now face structural headwinds. Regulators are unlikely to close dozens of institutions simultaneously. The Deposit Insurance Fund, managed by the Federal Deposit Insurance Corporation, is designed for orderly resolution, not mass panic. So management happens in phases, quietly, methodically. The question is not whether the entire system collapses. It likely won't. The question is whether specific institutions absorb disproportionate damage. Financial history teaches a consistent lesson. The earliest signals are subtle. The official confirmation arrives last. Confidence is powerful. But blind confidence is dangerous. There is no need for panic. Panic destroys judgment. There is a need for awareness. If your deposits exceed insured thresholds, reassess. If your bank shows multiple distress indicators, reconsider. If your financial strategy assumes perpetual stability, revise it. Because risk rarely announces itself loudly. It whispers first. And this is where everything becomes clear. Systemic stability does not guarantee individual protection. You must position yourself on the right side of asymmetric risk, preserve capital first, seek return second. That mindset separated those who survived previous cycles from those who were blindsided. Now I want to hear from you. Are you holding more than $250,000 in a single institution? Do you feel confident in your bank's exposure profile? Or are you reconsidering your strategy? Drop your thoughts below. If this breakdown gave you clarity, not fear, but clarity, then subscribe to Economic Tales. This channel exists for one reason: to decode financial signals before they become headlines. Share this with anyone running a business or holding significant deposits in regional banks, because by the time the announcement comes on a quiet Friday evening, decisions are no longer yours to make. Stay sharp, stay informed, stay ahead. I'll see you in the next one.